Now let's refer back to our original example that we were using in video number 1. And instead of just focusing on mapping zones, let's break down which model of the supply and demand zones that we've mapped out, whether it be continuation or reversal and so on and so forth. So what we'll do is we'll start on the left side and just work our way to the right based on the zones that we mapped in the prior video. And what we can see if we just zoom out just a little bit more is we had that original range that we mapped out in the first video, and then we were able to refine it to more of this range, and then finally this actual pivot, which is where and what we based our zone, our demand zone off of. And what we can see is price is moving to the upside, and from that sort of information, what we can see is that this would be more of a continuation. What we can see is price has been moving in an uptrend. We're seeing that expansion to the upside, and then we see price create a sideways range and then expand to the upside, breaking out of that range to the upside, which is the basis of our range created demand zone continuation model. Also, what we can see is we had that price expanding to the upside. We had price move a little bit sideways, but if we just more or less disregard this information, we can see that price moves sharply to the downside and then expands to the upside. And we can even see that more fractally, that we have this sharp move to the upside and then an expansion, which is part of the larger range. This is the smaller range, and then this is the smaller pivot within that. So either way we look at it, we know that we have range created demand and we have pivot created demand. We can also see that we've come from an uptrend, we've created that range or that pivot, and we've continued to the upside. Therefore, this is a continuation model. And then if we just continue, this one's a little bit easier to explain and really just to see. Again, we have a range, we have an expansion to the upside, a range in price, or a pivot, and then an expansion to the upsides, another continuation model to the upside. Now, what we can see is as we continue, we have a move to the upside, we have a sideways correction or a range, and then an expansion to the downside. Or more specifically, we have a move to the upside, pull back down, another sharp move to the upside, and then an expansion to the downside. So this would be our reversal supply zone that is coming into play right here. As we can see, we came from an uptrend, we ranged, and then we moved back to the downside, and then we'd be looking for price to return back to the zone. Now, if we continue on, once again, we have another range that came from a down move or a pivot and then creates an expansion to the downside. So either way, if that we look at it, we can see that this is also a continuation model. Now, if we look at this demand zone, we can see that price ranged. We came from a down move, or we pivoted, and then we moved or expanded to the upside. So what we can see from this is a reversal model within the framework of a demand zone creation. The next one, as we can see, we create a sideways correction. We come from an up move and we range or create a pivot and expand to the upside. So we have a continuation model of demand. And we see that we range or create a pivot coming from an up move, and then we move back to the downside. So this is a reversal model supply zone creation. And what we can see here, we get an expansion to the downside. We have a pivot to the upside and then an expansion to the downside. So this supply zone would be a continuation supply zone. Now, if we look at this point, we have an expansion to the downside. We do get a reversal and we see price expand to the upside. We range and then move to the upside. So this in itself, this demand zone is a continuation model. Now, if we were to look fractally in this wick, and it's something that we'll expand on in a later video, we would see a reversal demand zone being created at this point in time. But as right now, and as we only stay on the 15-minute expanding on the initial video's examples, but what we could do if we just want to expand on this and touch on this just a little bit, we have a sharp move to the downside, especially in this wick, and then we get that push up. So we could use this as a pivot demand zone. And what we can also frame is this candle right here is a range on a lower time frame. So we do have that range created demand being met, and what we can see is price expands out and then we range once more and create that continuation model. And what we'll do, we'll once again just keep continuing on just to drive the point home a little bit further. Again, what we have is we have a large range in price. I know what we said in the previous video that if we have a large range like this, chances are if we go up a time frame, this would be a tighter range, or more specifically, it's an area that we shouldn't focus on too much, or look to refine in other ways. And what we can see is we do get that sharp move to the upside, this pivot, and then an expansion to the downside. And as we can see, if we just draw it quite easily, we have come from an up move and then we've come back to the downside. So this is a reversal model. And then if we just continue on, what we can see is we create a range down here, much smaller, as it's only seen on a couple candles. We have a reversal demand zone being created. We have right here with this singular candle. I'm getting a little bit more in depth in the fractal nature. Again, we're going to build on this, but just kind of showcasing some of the things that we can be looking at, and without focusing too much on what happens on the right side of the chart in this particular video, but also showcasing a little bit what happens on the right side of the chart, just to get your mind thinking about these things. If you've often looked at a price chart and seen price return back to what unseemingly looks like one random candle, we can start to expand on that, and we will expand on that quite deeply as we continue on throughout the course. What we can see is we have this continuation model. As we've came from the downside, we've ranged and came to the upside. So we have our reversal demand. We expand to the upside, we pivot, and then we continue to the upside. So we have our continuation model here. And then if we look at this continuation, we retest into that. We've tested into this. And what we can see here is, if we're just looking at this, we do have a very large pivot, which again is coming from an up move and then creating a down move. So this would be a reversal. But what we can see is we've been able to more or less refine it to this move, because as we see, we get this move to the downside, we get a pivot, and then we break structure. And if we're just looking at supply and demand, and again, we'll go into this in a little bit further, but the interaction between supply and demand, what we can see is when we create this large move to the upside that taps into this supply, we do in fact create a demand zone, or more specifically a larger demand zone. But this reaction is not incredibly large. I think we can all admit to that. We get a nice solid bullish candle, price expands to the upside, but we don't get any follow through. But what we can see is price does begin to react to that demand zone and begins to fall through and creates a downtrend. But again, just touching on that initial comment that I made in the first video, is we do and will see reactions to almost every single supply and demand zone that are printed on the chart. But it's our job as traders to build a probability model for each of these supply and demand zones, adding on to all of the demand and supply zones that are around it, what price is reacting to, and then looking at that particular supply or demand zone and asking yourself, would this demand or supply zone hold given all of the other information that surrounds it? Not only that on that singular time frame, but then also looking at your multi-time frame, understanding what the overall trend and things like that are. Again, we're going to build up on to all of this, but I bring this up more or less just to get your mind thinking as we continue to build on. We started out with how we actually map out supply and demand zones, and here we are adding on to the actual different types of models, whether it be continuation or reversal. That way you can start to frame up trades if you're looking to either scale into a already existing trend using a continuation trade, or looking to take more of a reversal once we get into a potential point of interest. And this is how we build up trade ideas. And then also finally, just adding on to a piece, the interaction between supply and demand, the fact that we're always going to see reactions to zones, and it's our job as traders to figure out if that reaction is worth trading or not. But as we can see, we have, in this case, a continuation model. If we were to use more of this larger supply candle, this pivot, we would have a reversal model. So we have a model within a model. That being said, of course, when we're looking at this time frame, this is an incredibly large zone for such a small reaction. So it's better to begin thinking about the continuation aspect. And that's why it's important to understand how continuation and reversal models work and how they interact with what is happening on a price chart. And then finally, we'll just wrap it up in these last few models. What we can see is price created this larger range in price. We came from an uptrend and then we've expanded to the downside. So what we can say from that is this entire range is a reversal pattern. But if we take it a little bit further, and especially if we were to drop onto a lower time frame, we can see that price moves to the downside. We pivot up and then we expand. So we can also view this as a continuation model. And what you'll see, and as we stress the fractal nature of the markets, is initially we would derive this as a reversal model, but then within it, we could also derive it as a continuation model, because especially as we're creating ranges, we can get price action that looks something like this. And again, what I said in the mapping video is we can draw our entire supply zone based off of the range that is created, or we can refine it to the pivot. And then if we just look at price action here, what do we have? We have a down move, we have a pivot, and then we have a down move. So if we just take what we know about continuation and reversal patterns, if I just continue this on, if we look at the range in itself, this is a reversal model. But if we're just factoring in this bit of price action, this pivot, then this is a continuation model within it. So we're building on to the overall framework of what is happening with order flow. Yes, the whole picture is a reversal, and then we're starting to see price continue into that move. And then if we look at this point, we have, again, a larger range, or more specifically, a sharp pivot. More specifically, again, this pivot right here. Of course, if we navigate it up to a higher time frame, we might see something a little bit more aggressive. Then we can see that we have a more continuation styled supply zone. And then we move back down in, and what we can see is in this small candle, again, touching on the fractal nature, we have a move to the upside, a pivot, and then a move to the upside. So we have a continuation model. We have a larger pivot coming from an uptrend, and then another expansion to the upside, a continuation model. So that's a really quick run through on the continuation models. Again, the main things that you're looking for are an expansion to the downside followed by either a range or a pivot, and that would create our continuation models. Or on the flip side, we'd be looking for price to move to the upside, range, and then move to the upsides, or price to move to the upside, pivot, and then move to the upside. These would be our continuation models that we would be looking for. And then on the flip side, looking for reversals, we'd have a move to the upside, a range, and then a move to the downside, or a move to the upside, some sort of pivot, and then a move to the downside, or a move to the downside, a range, a move to the upside, move to the downside, a pivot, and then a move to the upside for our reversal models. Now, what you'll need to do next, and what I strongly encourage and recommend now that we've gone through some examples here, to take this application and apply it to your own charts. A good thing to do is apply the understanding that you've gained from these videos into the examples that you created in your first assessment that you took place in when you were just simply mapping out the zones. Start to take the time to identify, is it a continuation or is it a reversal model, and map out all of that. Take a blank chart, maybe do it again, and just get really comfortable with, one, understanding how to map the zones, and then two, understanding what each of these zones is representing, whether it be continuation or reversal. And as we go, what we will be expanding on is how to identify a trend on a higher time frame, mark out higher time frame supply and demand zones, and then use the lower time frames to either scale into trades using continuation plays, or looking for reversal models when price is correcting and things like that. We're going to really build on that sort of information, but initially the most important thing is understanding how to map zones, and now the difference between the continuation and the reversal models. One other thing that I will add, and you'll probably see it through your testing, is the higher probability models are always going to be the reversal models. And when you think about it from a logical sense, we're looking at value areas that large orders, which are usually derived from institutions entering the markets, are being executed. And as a result, they're going to want to sell when price is high and buy when price is low. Generally speaking, some of the volume that gets injected on continuation patterns, they are effective, but in a lot of cases, they're more liquidity building aspects. I know we haven't explained what liquidity is, and we will dig into that in a lot of detail in future videos. But again, just to get you thinking. But what I'm getting at when I explain what I just said was basically that the higher probability models that are more than likely to play out are the reversal models, and the continuation models are a little bit less likely to play out. Now, with that said, of course, continuation models are going to play out, but what your mind should be thinking of is, if I know that the reversal models have a higher probability of playing out over the long term, and the continuation models are a little bit less likely to play out, you need to start to build trade ideas that base around reversal and then the initial continuation. Because as you get further up in an up move or further down in a down move, the more continuation models that play, the less likely that they are actually going to play out from a trade standpoint. So when you go through mapping out continuation and reversal models, just be mindful of each of the models and what ends up happening on the right side of the charts. Now, of course, don't fixate too much on the result of the zone. Again, like the first video, the emphasis is on just getting comfortable with mapping out the zones and then identifying whether they are continuation or reversal models.